Swayam Prabha. Digital India. Educated India.
योगः कर्मसु कौशलम्.
Hello students, I, Dr. Dhaval Nakum from Gujarat University welcomes you all to the third part of accounting concepts, conventions and principles and accounting standards. Previously, we have discussed entity concept, money measurement concept, periodicity concept, accrual concept and matching concept in previous modules. We will continue with the same topic to study the remaining concepts in this part. Number 1, going concern concept. Number 2, cost concept. Number 3, realization concept. Number 4, dual aspect concept. Number 5, conservatism. Number 6, consistency. And number 7, lastly, the materiality. Let us commence with the going concern concept. Going concern concept. When any business is commenced by an entrepreneur, it is expected that the business will remain for generations. Many times it is observed that firms have been functioning for 4 to 5 generations. The life of every human being is decided by nature, but the life of a business cannot be predetermined. All businesses run on the assumption that the business will continue for an indefinite period of time. This is also called the concept of definite accounting period. As per the going concern concept, an indefinite life of the entity is assumed. Bombay Dyeing, founded in 1879 in Mumbai, Dabur established in 1884 and Tata Steel established on 25th August 1907 in Jamshedpur are examples of companies with more than 100 years of existence. Their long life in the market is a result of the going concern concept. The financial statements are normally prepared on the assumption that an enterprise is going concern and will continue in operation for the foreseeable future. Hence, it is assumed that the enterprise has neither in the intention nor the need to liquidate or materially curtail the scale of its operations. If such an intention or need exists, the financial statements may have to be prepared on a different basis. The valuation of assets of a business entity is dependent on these assumptions. Due to the stable value of money concept, historical cost is followed. Accounting effects and its presentation in annual financial statements. Illustration. Number 1. Acquisition of fixed assets. Fixed assets are acquired for long periods of time. The investment duration in fixed assets is more than 5 years and sometimes it can be 10 years or more. The basic role of fixed assets is to assist in day-to-day operational activities. Every year, these fixed assets are shown in the balance sheet after deducting depreciation. The depreciation amount is charged to the profit and loss account or income statement as a non-cash expenditure. These assets are not acquired for periods of 1 year or less. After the estimated life of a particular asset is completed, new assets are acquired with the expectation that the business will continue. This procedure is followed due to the going concern concept. Second is prepaid or advance payment. Prepaid expenses or advance payments are shown on the asset side of the balance sheet because of the going concern concept. It is assumed that the business will run for an indefinite period of time. it is estimated that the business entity will get the benefit of such prepaid expenses in the future. Number 3. Deferred revenue expenses. Deferred revenue expenses are shown on the asset side. These are expenses from which benefits will arise for a period of more than 1 year. For example, advertisement expenses paid for 5 years would appear in the balance sheet. Every year, an equal amount will be deducted from it and charged to the P&L account or income statement. This procedure is followed due to the going concern concept. Number 4 is semi-finished goods and work in progress. Semi-finished goods and work in progress at the end of the current year will be carried forward to the next year, and the remaining work will be completed during the next year based on the assumption of the going concern concept. If this concept does not prevail, semi-finished goods and work in progress could have been sold in the same year. Next is accounting period. The necessity of this concept emerges from the going concern concept. All stakeholders examine annual financial statements for the revision of investment decisions. Number 6. Capital and revenue transactions. The distinction between capital and revenue transactions support the going concern concept because all capital transactions are recorded with this assumption. This is a very optimistic concept. The commencement and continuation of business are assumed to last for generations. This concept is very useful for corporate forms of business where funds are provided by different stakeholders with the expectation of good return in the long term. Now let us discuss the second concept, that is cost concept. It is also known as the historical cost concept. In accounting, different types of cost are used for specific purposes and places, such as future cost, replacement cost, current cost, historical cost, inflationary cost, etc. In financial accounting, the focus is on the historical cost concept. The benefits of following historical cost is to maintain uniformity in the accounts year to year. When applying these concepts, the value of an asset is determined based on its historical cost, which is the purchase cost. Although there are various measurement bases, accountants traditionally prefer this concept in the interest of objectivity. For example, if an asset is acquired by paying rupees 50 lakh following the cost concept, the value of the machine taken as rupees 50 lakhs. The estimated life of this asset is 10 years. These rupees 50 lakh will be disclosed in the balance sheet, and every year rupees 5 lakh will be deducted as depreciation. After deducting depreciation, the remaining amount will be shown in the balance sheet. This process will continue until the completion of the 10th year. The historical cost concept is highly neutral and free from bias. Other measurement bases are not as objective. It is not allowed to disclose the current cost of an asset because it is not easily determinable due to several external factors like inflation, interest rates, and foreign exchange rates for international transactions. This concept has certain limitations. Number 1, the estimated realizable value is subjective, making exact value determination difficult. Number 2, in an inflationary situation, when prices of all commodities go up, on an average, acquisition cost loses its relevance. For example, a piece of land purchased on 1/1/2001 for rupees 25,000 may cost rupees 12 lakh as on 1/1/2024. So, if the accountant makes valuation of assets at historical cost, the accounts will not reflect the true position. Number 3, many assets do not have acquisition cost. Human assets of an enterprise are an example. The cost concept fails to recognize such asset, although it is very important asset of any organization. Many other controversial issues have arisen in financial accounting that revolve around the cost concept, which will be discussed at an advanced stage. However, later on we shall see that in many circumstances the cost conventions is not followed. See the conservatism concept for an example, which will be discussed later in this unit. Now we will see the accounting effects and its presentation in annual financial statements. Illustration: a machine was purchased on 1/4/2021 for rupees 10,50,000 and has an estimated salvage value of rupees 50,000, which will be realized after 10 years. On 31st March 2024, its market value is rupees 8 lakh. How would you disclose this machine in the annual financial statement on 31st March 2024? Let us see. On 1st April 2021, machine purchased. In the opening balance sheet, machine will be shown at rupees 10,50,000 on the asset side. On 31st March 2022, depreciation will be calculated. Rupees 10,50,000 less 50,000 of salvage value divided by the 10 years, we get 1 lakh rupee. It means every year depreciation of rupees 1 lakh will be deducted, and up to 31st March 2024, that is for the 3 years, depreciation will be of rupees total 3 lakh. On 31st March 2024, machine would appear at rupees 7 lakh after deduction of depreciation of 3 years. Market value of machine on 31st March 2024 is rupees 8 lakh, which is irrelevant due to application of cost concept. Now let us understand realization concept. Financial accounting rigidly follows certain concepts to maintain uniformity in presentation. It believes in reality rather than imagination and is closely associated with the historical cost concept. Any change in the value of an asset is recorded only when the business realizes it. For example, if an asset is recorded at its historical cost of rupees 5 lakh and its current cost is rupees 15 lakh, such a change is not counted unless there is certainty that the change will materialize. Financial accounting, based on some conventions, follows a more conservative path. According to conservatism, accountants try to cover all probable losses but do not consider any probable gains. This means that if accountants anticipate a decrease in value, they count it. But if there is an increase in value, they ignore it until it is realized. Economists are highly critical of the realization concept, arguing that it creates value distortion and makes accounting meaningless. However, financial accounting continues to adhere to such concepts. The perception of accounting community and economists differ. Now we will see the accounting effects and its presentation in annual financial statements. Illustration: for example, Mr. X purchased a piece of land on 1st January 2011 paying rupees 12 lakh. Its current market value is rupees 22 lakh on 31st December 2024. Should the accountant show the land at rupees 22 lakh following cost concept and ignoring rupees 10 lakh value increase since it is not realized? Look at the balance sheet. Here capital is shown at rupees 12 lakh and land is also shown at rupees 12 lakh on the asset side. Another balance sheet is prepared by accountant including new value of piece of land, the revised balance sheet. Now look at the balance sheet. Capital rupees 12 lakh, unrealized gain rupees 10 lakh, and land is valued at rupees 22 lakh. This disclosure is not allowed as per the realization concept. This gain is not realized in a real sense. If this piece of land is sold, then Mr. X could have earned rupees 10 lakh, which could have been disclosed in the books of account. Nowadays, the revaluation of assets has become a widely accepted practice when the change in value is of a permanent nature. Accountants adjust such value changes through the creation of a revaluation, that is capital reserve. At present, a little flexibility is approved subject to certain conditions. All three concepts, the going concern, cost concept and realization concept, provide the valuation criteria. Now, we will see the fourth concept, that is dual aspect concept. Double entry bookkeeping is a widely used accounting method where every business transaction has two effects, a debit effect and a credit effect. Furthermore, the total amount debited will always equal the credited amount, making the total of both debit and credit identical. This concept is the core of double entry bookkeeping. Every transaction or event has two aspects, and business transactions are always in the context of either assets, liabilities, incomes, expenses, or a mix of any two. We have already studied the dual aspect under the accounting equation method. Under this method, the effects of incomes and expenses are directly recorded where applicable, whether in capital, liabilities, assets, or any combination thereof. We will repeat these to understand the concept once again. Let us consider all possible effects of business transactions. Number 1, it increases one asset and decreases another asset. Number 2, it increases an asset and simultaneously increases liability. Number 3, it decreases one asset and increases another asset. Number 4, it decreases one asset and decreases liability as well. Alternatively, number 5, it increases one liability and decreases the other liability. Number 6, it increases a liability and increases an asset as well. Number 7, it decreases liability and increases other liability. Number 8, it decreases liability and decreases an asset as well. Now, we will see the accounting effects and its presentation in annual financial statements. Let us recollect the applicability of dual aspect with illustration. You can see, based on transactions, number of columns are prepared. We already know the equation assets equals to capital plus liabilities. Now, number 1, brought rupees 50,000 and commenced business. Here, cash, that is an asset of the business, is increases and capital of rupees 50,000 is also increasing. Therefore, the accounting equation A is equals to C plus L is sustained. Now, the second transaction is furniture purchased for rupees 10,000. Furniture, an asset of the business, is increasing, whereas the other asset, that is cash, is also decreasing by the amount of 10,000. Third transaction is goods for rupees 12,000 purchased in cash. Here, goods, which is an asset of the business, is increasing, whereas another asset, that is cash, is decreasing by the same amount of rupees 12,000. Fourth transaction is goods for rupees 8,000 is purchased from B. Here, goods, that is an asset of the business, is increasing and liability towards B of rupees 8,000 rupees is also increasing. So, assets and liabilities both are increasing. Number 5, goods of rupees 7,000 is sold for rupees 10,000 in cash. Here cash of 10,000 rupees is increasing. It means asset is increasing by the amount of 10,000 rupees. Goods is going out of the business. So goods, that is an asset of the business, is decreasing by the amount of 7,000, and profit, which is part of the capital, is increasing. Next transaction is rupees 6,000 paid for wages. Here 6,000 cash is decreasing and capital of 6,000 is also decreasing. Number 7, wages outstanding rupees 1,000. Liability towards outstanding wages is increasing, whereas capital is decreasing as wages is an expense of the business. Next is commission received rupees 4,000. Cash is increasing by the amount of 4,000. It means an asset is increasing by the amount of 4,000, and as it is an income of the business, capital is also increasing by the amount of 4,000. Therefore, again the equation A is equals to C plus L is maintained. Next transaction, dividend received rupees 9,000. Here cash is increasing by the amount of 9,000 and dividend is our income. Therefore, capital is also increasing by the amount of 9,000 rupees. Next transaction is machine purchased rupees 8,000. Here cash is decreasing by the amount of 8,000 and machine, which is also an asset of the business, is increasing by the amount of 8,000 rupees. Next transaction is land purchased from Radha for rupees 25,000. Here the name of the seller is given. It suggests that we have purchased land from Radha on credit. Therefore, asset worth 25,000 is increasing and liability towards Radha for the amount of 25,000 is also increased. Last transaction is borrowed bank loan of rupees 20,000. Here cash is increasing and liability towards bank is also increasing. In total, assets equals to capital plus liability, that is assets worth 1,13,000 equals to capital rupees 59,000 plus liabilities 54,000 is equal. Now we will see the balance sheet based on the above transaction. We can see that total of cash is 57,000, which is shown on the asset side. Furniture rupees 10,000, again shown on the asset side. Goods, total of goods for the amount of rupees 13,000 is shown on the asset side. Machine 8,000 and land rupees 25,000. On capital and liabilities side, capital worth rupees 56,000 is shown on the liabilities side, plus profit of 3,000 is added, so we get 59,000. In case of liabilities, B's account rupees 8,000, outstanding wages 1,000, Radha's account 25,000 and finally the bank loan 20,000. It equates the balance sheet by the amount rupees 1,13,000. Another important concept is conservatism. Some traditions followed in society are need based. In accounting, along with principles, a concept of conservatism is followed. Conservatism is a kind of precautionary system. It states that the accountant should not anticipate income and should provide for all possible losses. When there are many alternative values of an asset, an accountant should choose the method which leads to the lesser value. Later on, we shall see that the golden rule of current asset valuation, cost or market price, whichever is lower, originated from this concept. The realization concept also states that no change should be considered unless it is actually materialized. The conservatism concept is the second controlling factor. It is not prudent to consider unrealized gain, but it is desirable to guard against all possible losses. For this concept, there should be at least 3 qualitative characteristics of financial statements, namely, number 1, prudence. All possible losses or anticipated losses are part of the account, but anticipated gain has no place in accounts as per the feature of prudence. Prudence conveys a kind of carefulness in the preparation of accounts. Number 2, neutrality. The core part of accounts is that they should be prepared objectively, meaning unbiased. Due to objectivity quality, accounts are accepted by all without reservation. Number 3, faithful representation of alternative values. There are some different views about this concept. Many accounting authors, however, are of the view that the conservatism essentially leads to the understatement of income and wealth and should not be the basis for the preparation of financial statements. But this concept has its own positive role in the accounting system. Now let us see the accounting effects and its preparation in annual financial statements. Illustration. Number 1. At the end of accounting year, company has closing stock of rupees 1,20,000, but its market value is of rupees 1,05,000. The value of closing stock will be taken at rupees 1,05,000. Closing stock is always credited. Instead of crediting rupees 1,20,000, 1,05,000 is credited due to the conservatism concept. So, the profit would reduce by rupees 15,000. This is a possible loss. In the balance sheet, on the asset side, stock would appear at rupees 1,05,000. Second transaction is the closing balance of debtors of firm is rupees 70,000. As per tradition, 5% BDR, that is bad debt reserve, is maintained. BDR is a provision. Debtors are the result of credit sales of the current year. BDR is an anticipated loss. It is to be provided from the profit of current year. So, BDR of rupees 3,500, that is 5% of rupees 70,000, will be debited to the P&L account. Consequently, profit would reduce by rupees 3,500 due to the consideration of the anticipated loss of rupees 3,500. Now, let us study consistency. Consistency is the quality of always having the same standard, opinions, behavior, etc. Financial statements of corporate sectors are used in the public domain. Consistency in annual reports maintains the trust of different users of annual reports, specifically the trust of investors and moneylenders. Further, to achieve comparability of the financial statements of an enterprise through time, the accounting policies are followed consistently from one period to another. A change in an accounting policy is made only in certain exceptional circumstances. According to ICAI, the concept of consistency is applied particularly when alternative methods of accounting are equally acceptable. For example, a company may adopt any of several methods of depreciation such as the written down value method, straight line method, etc. Likewise, there are many methods for the valuation of inventories. But following the principle of consistency, it is advisable that the company should follow consistently over the years the same method of depreciation or the same method of valuation of inventories which is chosen. However, in some cases, though there is no inconsistency, they may seem to be inconsistent apparently. In case of valuation of inventories, if the company applies the principle at cost or market price, whichever is lower, and if this principle accordingly results in the valuation of inventories in one year at cost price and the market price in the other year, there is no inconsistency here. It is only an application of the principle. In certain situations, accounting policies may be changed. Number 1, due to mandatory accounting standards. Number 2, to meet any new legal requirements. Number 3, in case of amalgamation. Number 4, in case of demerger. Now, we will see the accounting effects and its presentation in annual financial statements. Illustration. Transaction number 1. Shifting from the straight line method SLM of depreciation to the written down value method, that is WDV. Under the SLM, the amount of chargeable depreciation will be similar throughout the life of the asset. In contrast, under the WDV method, the amount of depreciation will be higher in the initial years and gradually reduce significantly over time. Next transaction, shifting from LIFO method to FIFO method of inventory valuation. There is an impact of the valuation method on the value of closing stock. During inflation, if the FIFO method is used instead of the LIFO method, the value of closing stock will be higher and ultimately profit will be higher and vice versa. Due to inconsistency in accounting, the financial results of each year will be different, and unfortunately, they will not be comparable for making any managerial decisions. Finally, let us close discussion with the last concept of today's session, materiality. Accounting says each and every transaction must be recorded and given due importance. At the same time, the effect of some transactions does not affect the financial performance and status of the business unit. Such transactions can be ignored. This concept provides some relaxation for accounting treatment of specific transactions. The materiality principle permits other concepts to be ignored if the effect is not considered material. This principle is an exception to the full disclosure principle. According to the materiality principle, all items having a significant economic effect on the business of the enterprise should be disclosed in the financial statements. Any insignificant item that will only increase the work of the accountant but will not be relevant to the user's needs, therefore should not be disclosed in the financial statements. The term materiality is the subjective term. It is on the judgment, common sense and discretion of the accountant that which item is material and which is not. Now we will see the accounting effects and its presentation in annual financial statements. Illustration. Transaction number 1. An accounting year ends on 31st March 2024 and a bill for services is received for the period of 3 months from 2nd January 2024 to 1st April 2024. Only one day pertains to the next year, that is 2024-25. In this case, calculation of the bill for one day is not required and the entire amount can be charged in year 2023-24. Second transaction, for example, certain loose tools are purchased for rupees 20,000, out of which tools worth rupees 300 remain unused. The total production cost of the year is rupees 5 crores. The value of closing stock of tools is very negligible against the total production cost. In this situation, it is taken as 100% in the year of purchase, even though used by the entity for more than a year. This is because the amount of loose tools is very small to be shown in the balance sheet, though it is an asset of the company. To determine the materiality status of transactions, factors such as the amount of the item, size of the business, the nature and level of information, and the level of the person making the decision are taken into consideration. Moreover, an item material to one person may be immaterial to another. What is important is that the omission of any information should not adversely affect the financial position of the respective accounting year or impair the decision making of various users. In this module, we have studied about the going concern concept, cost concept, realization concept, dual aspect concept, conservatism, consistency, and finally materiality. All these aspects are explained with accounting treatments and their presentation in financial statements. I am sure that you must have acquired reasonably good understanding of them. Clarity about all accounting concepts, conventions and principles will put you in comfortable position to learn advanced issues of accounting. In the next module, we will discuss accounting standards, which plays a vital role in the preparation and presentation of annual financial statements. We will meet in short time for accounting standards. Thank you guys.